Hello guys, good day. Welcome to another video lecture in ACC 311 Income Taxation. In this specific video lecture, we will be continuing our installment of discussion for deduction for or deductions from gross income. In the immediate previous video lecture that we had, we already discussed what is a deduction from the gross income. Okay? As per recap, as a sort of recap, when we talk about deductions from the gross income, these are gross income or deductions to gross income or items that is again legitimate expenses or cost on the point of view of the taxpayer regardless if they are individual or corporation. So in the previous lecture, we were able to discuss interest expense, taxes, and losses, as well as the general requisites of deductibility of a general expenses. So in this second installment of our discussion, we will be discussing about the requisites of deductibility for the following items. Number one, bad debts. Depreciation, depletion, charitable and other contributions, research and development, and at the same time your pension trust. So let us start with our discussion with bad debts. So bad debts is not a strange topic or a strange concept on your part, guys, because bad debts is the one very common na item that we account in your intermediate accounting. So bad debts are considered as item to be deducted to our gross income as long as it follows the requisites for its deductibility. Una, there must be an existing indebtedness due to the taxpayer, which must be valid and legally demandable. And then letter B, connected with taxpayer's profession, trade, or business, not sustained in a transaction entered into between related parties. So in the previous discussion, guys, we made into an account who are related parties, no? So we have human being and artificial being na mga related party transactions. So related party transactions includes family members or in terms of artificial being, those corporations with control with another corporations. And then letter D, actually charged off the books of accounts of the taxpayer as of the end of the taxable year and actually ascertained to be worthless and uncollectible as of the end of the taxable year. So in this case, guys, the perfect timing for us to deduct bad debts is when it becomes worthless. Okay? So obviously when we recognize allowance for doubtful accounts, then we can deduct that allowance for doubtful accounts yet as deductible bad debts. Okay? It's when we ascertain that that allowance for doubtful accounts or portion of that allowance for doubtful accounts is already uncollectible. So that's the time of the accounting or of the taxable year where we could deduct bad debts. So measurement of bad debts. So if a corporation computes the income upon the basis of valuing its notes or accounts receivable at their fair market value, the amount deductible for bad debts is in any case is limited to such original valuation. So a purchaser of accounts receivable which cannot be collected and are consequently charged off the books as bad debts is entitled to deduct them. So the amount of deduction being based upon the price paid for them and not upon the face value of the accounts receivable. So in this case, as we know that accounts receivable can be assigned, so when there is assignment of accounts receivable, guys, or when there is actually selling of accounts receivable, and the buyer of that accounts receivable can no longer collect that AR, then therefore, whatever is the amount paid by that buyer of AR can deduct whatever is the amount actually paid by him or her to the seller of that particular AR. And then letter C, only the difference between the amount received in distribution of the assets of a bankrupt company and the amount of the claim may be deducted as bad debt. So for example, there are accounts receivable and then the debtor is, let's say, a corporation and that corporation is liquidating already, and then the AR is only partially paid by that liquidating corporation. So in that case, guys, um, the portion which is not paid is the amount that can be deducted as bad debts. And then the difference between the amount received by a creditor to a decedent in the distribution of the assets of the decedent's estate and the amount of the claim may be considered as worthless debt as well. So for us to be enlightened, let us use this into an illustration. So assume that in 2018, a taxpayer estimated that 140,000 of its accounts receivable was uncollectible in 2000 was uncollectible. But it is on 2019 where 90,000 of the accounts was ascertained to be worthless and a write-off has been effected. And then the related entries in the books are shown as follows. So in 2018, there is an entry debit to bad debts and credit to allowance for doubtful accounts or bad debts for 140,000 to establish your estimated uncollectible. And then on 2019, 90,000 no, of your allowance for bad debts was actually considered as worthless. So you write it off. So to entry, your writing off your worthless account. So debit ka ng allowance for bad debts and credit to accounts receivable for 90,000. So as mentioned in the tax code, guys, that bad debts can only be deducted on the date or on the year it was considered worthless. So in this case, your 140,000 cannot be claimed as a deduction on 2018, but only 90,000 of that 140 can be deducted, but not on 2018, but on 2019, where it was actually written off. Okay? So that is your bad debts. Another guys, another item to be deducted to our gross income is your depreciation. The same with your bad debts, depreciation is not a stranger item for us because it's also one of the common items that we account in intermediate accounting or even in any other accounting, no? Depreciation, it is the allocation of cost for your depreciable assets or property, plant, and equipment in a form of expenses. So it can be deducted as long as it follows the requisites for deductibility that includes reasonableness of the depreciation, the property must be used in the trade or business, and then the property must have a limited useful life, and obviously there must be an allowance charged off during the year. Okay? Although in your intermediate accounting guys, we have taught of some of the different methods in depreciation or in depreciating our property, plant, and equipment and any other depreciable assets. The tax code has actually mentioned these applicable depreciation methods. Number one, straight line method, declining balance method, sum of years digits or SYD, and any other methods which may be prescribed by the Secretary of Finance upon recommendation of the Commissioner. So obviously, guys, in this subject, we will not be dealing about the computation procedures of depreciation. But what is important is that we know that this depreciation expense is a deductible item to the gross income. Okay? Because commonly in tax na subject, in computing for the taxable income, the amount of depreciation is usually given na. So, ang timan na lang nato guys is ang requisites and ang mga requisites for deductibility kay there are times na yes, there is a depreciation in the problem, but that depreciation may not be applicable and therefore cannot be deducted. So again, you need to master these items. Okay? We have also depreciation points that refers to properties used in petroleum operations. So depreciation of properties directly related to a production of a petroleum initially placed in service in a taxable year shall be allowed under straight line method or declining balance method on the basis of an estimated useful life of 10 years or shorter life as may be permitted by the commissioner. Yes, it is very vocal on the type of depreciation method. So dapat it will be depreciated using straight line and declining, using an estimated useful life of 10 years or shorter. Also, for properties not used directly in the production of petroleum, it can be depreciated under straight line method on the basis of an estimated useful life of 5 years. Aside from properties used in petroleum operations, we also have depreciation that can be claimed from properties used in mining operations, okay, at the normal rate of depreciation if the expected life is 10 years or less, or depreciated over any number of years between 5 years and the expected life of the latter is more than 10 years. Okay? So, somehow we don't have any complications in terms of the valuation of this depreciation, unlike with any other types of or any other items of deductible na items na naay mga limit or what na mga restrictions. But in this case, depreciation, as long as it follows the requisite of for deductibility, then therefore it can be deducted as part of the items nga mag-reduce sa ato ang taxable income. Another, guys, is the depletion of oil and gas wells and mines. So actually, depletion and depreciation together with amortization are just the same in nature, no? They actually are allocation of cost for an item that is capitalized initially. So depletion, this is the counterpart of depreciation for oil and gas wells and mines. Pero the properties used in these wells and mines are subject to depreciation. What is subject to depletion is the oil and gas wells and mines, or those what we call mga wasting assets. Okay? We also had discussed this topic, depletion, in your intermediate accounting, no? So the method of depletion that will be used here is the cost depletion method, and it is important to note, guys, that the depletable amount or the depletable value should not exceed, no, the amount invested in the mine. Okay? Also, intangible exploration and developing drilling costs are deductible in the year incurred if such expenditures are incurred for non-producing wells or mines. Okay? If non-producing, then therefore it will be deductible in full on a particular year where it was incurred. Pero when it is producing well, or the mines are the wasting asset is what do we call this, having enough minerals not to be extracted, so it can be deductible in full or maybe capitalized and amortized if such expenditures incurred are for yun nga producing wells or mines. So, pwede siya i-capitalize or pwede siya i-deduct in full. Pero kung non-producing, then of course, i-deduct mo siya in full on the year it was incurred. Pero kung producing well or mine, producing, there are expected na extraction to be made from that well or mine, then therefore, you have an option. Una, you can um, capitalize it and therefore subject it to depletion. And second, you can deduct it in full. And then the total amount deductible for exploration and development expenditures should not to exceed 25% of the net income from mining operations computed without the benefit of any tax incentives under existing laws. And actual exploration and development expenditures minus 25% of the net income from mining shall be carried forward to the succeeding years until fully deducted. Okay, that is for depletion of oil and gas wells and mines. Another, guys, is your charitable and other contributions. So charitable and other contributions is also popular, no? It's aside from business related expenses, charitable and other contributions also are um, common sources of deductions sa ato ang mga taxpayers. Okay? Charitable and other contributions are those donations made to domestic corporation recipients and any other um, specifically stipulated by that the tax code to receive ng mga entities, no? So, natay mga requisites also for deductibility before a donation can be claimed as a deduction. Number one, it should be actually paid or made within the taxable year. And then letter B, made to the Philippine government or any political subdivisions or to any non-profit organizations or institutions specified in the tax code. And lastly, it must be evidenced by adequate records or receipts. So upon contributing cash or any other types of asset to a particular recipient or donee, then proper substantiation should also necessary before you could claim such donation as a deductible contribution. Now, we have two types of contributions. So those contributions that are deductible in full and contributions which includes a limit. Okay? Let us talk first those contributions na merong limit. Okay? So, ang may limit are those contributions made for the use of government of the Philippines or any of its agencies or any political subdivision exclusively for public purpose, or those made to accredited domestic corporation or associations organized and operated exclusively for religious, charitable, scientific, youth and sports development, cultural or educational purposes, or rehabilitation of veterans, and as well as those contributions made to social welfare organizations and made to non-government organizations. Okay? On the other hand, when we talk about contributions in full, meaning whatever amount you have contributed, no, to to a specific organization that is stipulated by the tax code, whatever amount you have contributed to them, then therefore you can deduct it in full without any limitations. No, those are donations to government of the Philippines or to any of its agencies or political subdivisions, including fully owned government corporations, exclusively to finance, to provide for, or to be used in undertaking priority activities in education, health, youth and sports development, human settlements, science and culture, and economic development. Or in short, guys, those um projects that are prioritized by the National Economic Development Authority or by NEDA. Okay? And then also, deductible in full are those donation to certain foreign institutions or to international organizations, no? Or yung mga under treaties. So actually guys, si letter B, this is the exemption of the rule na before daw nimo maklaim ang charitable and other contributions, dapat ang donee or ang recipient sa donation is a domestic corporation. So si letter B, kani donations to certain foreign institutions or international organization is the exemption to that particular rule nga dapat domestic corporation ang modawat sa donation para mahimong deductible sa nag-donate. Okay? And then, letter C, donations to accredited non-government organizations or non-profit domestic corporations that is organized and operated exclusively for scientific research, educational character building, youth and sports development, health, social welfare, cultural and charitable purposes, or a combination of these. Dapat the dapat the donation which not later than the 15th day of the third month after the close of the taxable year in which the contributions are received, makes utilization of the contributions directly for the purpose or function for which the organization is organized and operated. So therefore, the recipient of the donation is given an ultimatum to utilize whatever is donated by the taxpayer. Okay? So dapat 15th day or the third month after the close of the taxable year, the the donee the donee or the recipient should be able to utilize the amount contributed by the taxpayer. And then the administrative expense shall all on annual basis not exceed 30% of the total expenses. So dapat guys ang admin expense sa donee kay dili 30% of the total expenses. Okay? Dapat um, majority jud dapat um, 70% at least no are the expenses para sa purpose kanung na-organize ang ilahang institution or non-government entity. And then the assets of which, in the event of dissolution, would be distributed to another non-profit domestic corporation organized for similar purpose or purposes, or to the state for public purpose, or would be distributed by a court to another organization to be used in such manner as in the judgment of said court shall be best accomplish the general purpose for which the dissolved organization was organized. So naatay mga specific na mga requisites no para i-consider nato ang isa ka non-profit domestic corporation nga ma-consider as donation, and then such donation donee, and then the donation made to them can be deductible sa kung kinsa man ang nag-contribute ato nga donation. So as mentioned earlier guys, natay mga specific gari na mga accredited non-domestic organizations. So we have una, Department of Social Welfare and Development, that is for charitable and social welfare organization, foundation, and associations. We also have Department of Science and Technology for research and other scientific activities. For Philippine Sports Commission, for their sports development, donations also to National Council for Culture and Arts or NCCA for cultural activities, and donations made to Commission on Higher Education for educational activities are all fully deductible contribution made by whoever is that particular taxpayer, may it be individual or a corporation or corporate taxpayer. So speaking of um, deductible contributions na may limit, no? Dara ang limit guys, 10% and 5%. So for individual taxpayers, they are allowed to deduct 10% of the taxable income derived from trade, business, or profession before charitable and other contributions. Meaning, kadtong taxable income nga wala pa nimo na deduct ang mga contributions or deductible contributions. Pero kung corporation, again, the limit will only be 5%. Okay? Now, how about when the donation made was not in cash, or in short, non-cash asset? So, what valuation method are we going to use, no? So, according to the tax code, the amount of any charitable contribution of property other than money shall be based on the acquisition cost of the said property. Okay? Kung pila ang acquisition cost, no? Not the fair market value. Common nato na hibalaan nga ginagamit nato as valuation when there is contribution of non-cash assets. But in this case, what will be deductible is the acquisition cost of the property. And then, we also have contributions made by general professional partnership. So, according here, when the deductible in full, when the contribution is deductible in full, then therefore, it will be deducted, no? The general professional partnership can deduct contribution in determining its net income. Okay, pag compute sa net income, i-minus nimo ang pag-compute nimo sa net income sa partnership, i-minus nimo ang charitable and other contributions. So therefore, mugamay nilang mogamay na ang ilahang distributable share and therefore mogamay pod ang ilahang net income per partner nga subject to basic tax. Pero kung ang deductible is with limit, ingon sa tax code, it shall be claimed and deducted by partners in proportion to their respective interest in the partnership. So, dili siya i-minus dito as a partnership net income, but will be claimed on the separate income tax return equal to their respective share, no, per partner. So, that is charitable and other contributions. Okay. So, again, natay illustration diri. Mr. Saryaya, a practicing accountant, had the following income and donations during the year. Okay? It has professional fees of 1.1 million, donation to government priority activities. It also includes donations in pursuant to treaties, no? Donation to international corporation pursuant to treaties, donations made to accredited charitable institutions, donations to government for public purpose, donations to non-accredited charitable institutions, donations to a foreign charitable institution, and then donations to street beggars, no? Sana all street beggars donated or has received 50,000 as donation, and other deductible business expenses of 600,000. So, in short guys, kung meron tayong here, kung naatay deductible contributions that is subject to limit. So the limit will be multiplied sa taxable income before contributions. So in that case, that will be 1.1 million minus 600,000 because taxable income man before any donations made, no? Or allowed na deductible, charitable, and other contributions. So to compute for the deductible contribution expense, then we have here the fully deductible contributions. So we have government priority activities for 100,000, those donation made to accredited charitable institutions, those donation made to treaty covered entities. So we have deductible in full totaling 180,000. So since it is deductible in full, then the entire amount will be deducted. Okay? And then we also have their partially deductible contribution. So take note that our taxpayer was individual. So therefore the limit will be 10%. Okay? So we have partially deductible contributions of 80 plus 60 from government non-priority activities and two non-accredited charitable institutions. So actually we have a total cost of donations made to them worth 140,000. But again, we need to compute the limit first because the limit will be whichever is lower, no? Obviously. So in that case, we have net income before contributions na 500,000 from 1.1 million minus 600,000. So we have 500 times 10% na limit. So therefore, the deduction limit will be 50,000. Compare it with the actual cost of contributions na 140. So therefore, the deductible deduction will be 50,000, no? Lower between the actual and the limit. So in this case, your total deductible contribution expense will be 230,000. Okay? Let's go back with the other donations. Now, there are items which are not subject to donations. Number one, you have there the donation to foreign institution that is not considered deductible unless it is in accordance with treaties. So it is referring to these 40,000 donations. No, since it is silent, no, stipulating that it's donating for a particular treaty, so therefore we can assume like that. So we can assume na any contributions made to international or foreign charitable institution, so again, that will not be deductible. And then, the donation to beggars is also not deductible because it is not made to a domestic organization. So again, ang rule na to, requisite para ma-consider as deductible ang contributions, it must be made to domestic corporation. Pero ano nga, ano na, na-exemption ato kadtong donation made to international organization under treaties. And then, contributions to non-qualified donee institutions, guys, are not deductible against gross income, and at the same time they are subject to donor's tax. So those items here na mga donations made by the taxpayer na wala na allowed by the law to be deducted as deductible contributions will be considered as donation to them. And take note that donation is subject to donor's tax. That is to be paid by the donor. Okay? To be paid by the donor. So one of the reasons, take note, why taxpayers donate or contribute to some organization, it is actually to lessen their taxable income and subsequently lessen their tax due. So in that case, um kung dili deductible, okay, or dili qualified ang donee institution or ang recipient institution, then it is the donor or the taxpayer who will incur more or will pay more tax instead of saving or having a tax savings from that contributions. Okay? Another, let's proceed with research and development. So research and development are expenses also or costs incurred by the entity in enhancing their current products and services provided to the public or to their customers, or even the initial research and development when an entity is still actually starting pa lang. So whatever cost incurred by R&D will be deductible, okay? As long as again it follows the requisites of for deductibility. So that includes A, paid or incurred by the taxpayer in connection with his trade, business, or profession. It is not treated as ordinary and necessary expenses, and it should be chargeable to capital account but not chargeable to a property of a character which is subject to depreciation or depletion. Okay? So the amortization period of deferred research and development should be made ratably and distributed over a period of not less than 60 months as may be elected by the taxpayer, or that is good for 5 years. Okay? Any research and development can be deferred and can be deducted for a matter of 5 years or monthly amortization, no, or 12 months per year. So beginning with the month in which the taxpayer first realizes benefit from such expenditure. And then any expenditure for the acquisition or improvement of land or for the improvement of property to be used in connection with research and development of a character which is subject to depreciation and depletion, and any expenditure paid or incurred for the purpose of ascertaining the existence, location, extent, or quality of any deposit or ore or other mineral including oil or gas. Okay? And lastly, we have pension trust. Okay, deductible pension. So pension, these are pension expenses of the employer accruing under the term of pension plan for services rendered by the employees. Okay? Or pension expenses are also deductible. So as long as they follow the requisites for deductibility, that includes reasonableness, established and maintained by the employer for the payment of pensions to employees, no? And then we have two types of pension or pension cost. Number one, we have current service cost. Current service cost refers to the pension expense of the employer accruing under the term of the pension plan for services rendered by employee during the year, and your past service cost. This is also referring to the pension expense of the employer accruing in prior years for services rendered by employee before the establishment of the pension fund, and additional pension expense accruing in years arising from improvements in the benefit offering of the plan. So in this case, the amount deductible for current service cost will be the entire amount, no? It will be deductible in full and will be considered as ordinary and necessary expenses. Pero those referring to past service cost, it will be apportioned in equal parts over a period of 10 years. So it will be amortized good for 10 years ang mga past service cost. Okay? Example, we have there an employer maintains pension trust for its employees having the following contributions for 19, 20, and 21. So it has current and past service cost, no? So compute for the deductible pension contributions for each year. So for example, for 2019, pila ang atong deductible pension contribution. So you have their current service cost. So as mentioned earlier, current service cost will be deductible in full, 100,000, and your past service cost will be amortized for 10 years. That 10 years is actually constant, no? So 80,000 divide 10, so that 80,000 divide 10, so that's 8,000. So 8,000 plus the current service cost for 2019, so that will be 108,000 deductible for year 2019. Talking for 2020, no? So 100,000 is also deductible in full, and then 60,000 will also be amortized for 10 years. So 60,000 divide 10, so that is 6,000 per year, plus the amortization of your past service cost for the year 2019 in 2020. Okay? So therefore, the total deductible pension will be the 100 current service cost, the 60,000 the past service cost for 2020, plus the 8,000 past service cost amortization for 2019. So therefore, in total, you could deduct 114, no? That's 6 plus 8, so that's 14 plus 100, so that's 114,000 total deductible pension contribution for year 2020. And then for 2021, you have their 100,000 current service cost, wala kay past service cost. So you will have um no past service cost for the year 2021. Pero naa kay amortization gikan sa 2019 and 2020. So there will be 8 plus 6 plus the current service cost of 100. So still you'll have 114,000 na deductible pension contribution for the year 2021. So same lang siya kay 2020. Okay? So that is for our pension. Okay, I think that's the end of our lecture for the second installment of our discussion for our items deductible to our gross income. So again, as a sort of recap, we have made a discussion on all the items, no? Including number one, all those um, ordinary and necessary expenses related to the conduct of business or practice of profession, or those interest expense, taxes, losses, bad debts, depreciation, depletion, charitable and other contributions, pension expenses or contribution to pension and trust, and at the same time your research and development costs are all deductible to your gross income in determining your taxable income. So again, as a note, it is important for us to master these items because in the actual practice, our client will not give us the amount deductible, no? They will not give us the lump sum amount of deductible expenses, but it is us the job of a tax accountant to determine and help our client to have or to determine the least taxable income as possible in order for them to pay the least amount of tax liability, obviously using the laws on our part, okay, or the legal means of having or escaping tax. So again, that's the end. If you have any more questions, so you can actually prepare that and we will be addressing that on our video lecture. or for immediate response, you can actually um, comment down below for any clarification or inputs that you would like to share. Okay? So I think that's the end. Thank you for watching and God bless us all.